Let's go.
In the Jeff's opinion, in the big bank's opinion, silver is simply an industrial commodity that crazy people who like shiny stuff enjoy hoarding because they're nuts. Whereas our side says that silver is a money. Hey guys, Rafa here from the End Game Investor, and today I want to discuss the Jeffs, Gettr Christian and Geoff Curry, and that school of thought on silver, what silver really is, what the argument between our school of thought and their school of thought actually is, what drives the argument, and why there is always a silver spike when there is a monetary panic, and what is the role of physical silver. First of all, there's been some murmurings on our side of the monetary equation that Geoff Christian said something stupid again, and everybody's upset. So I'm going to try to break down this argument in conceptual terms and why the two sides of the silver analytical market can't seem to talk to each other. The argument centers around what silver is. The Jeffs, Geoff Curry and Geoff Christian, believe that there is no manipulation of the silver market because silver is only an industrial commodity and not a monetary commodity, and there are no industrial shortages of silver, therefore there can be no manipulation of silver down. Our camp believes that silver is an industrial commodity, yes, that cannot be denied, but it is also a monetary commodity, whether or not silver is officially backing the dollar or not. Our side believes that silver is a monetary commodity because that is how the dollar was born, as a silver substitute. Until 1873, the dollar was silver. In the Constitution, the dollar is defined as a weight of silver. That's what the definition of a dollar was. And by the monetary regression principle that all prices have to go back into the past, meaning the only reason you know how much things cost today is because you knew how much they cost yesterday, and so on into the past, when the dollar was born as a silver substitute. Now, if silver is a money commodity, then the true money price of silver, monetary price of silver, not the industrial price, the monetary price, is the price at which every single dollar can be exchanged for every single ounce of monetary silver that exists above ground today. What is that exchange rate? Why is that the monetary price? Because everybody needs money to participate in the division of labor. Now, Geoff Christian and Geoff Curry could say to us, well, you don't need physical silver to serve as money because we have the Federal Reserve and blah, blah, blah. Okay, now here's the answer to that question. I would say, or our camp would say, look at this chart. This is the long-term gold to silver ratio. You see here that this is the monetary ratio when the dollar was silver. It was literally the definition of a dollar was a certain weight of silver. I forgot how many grains, but it was in the Constitution, etc., whatever. And every time there is a monetary panic, silver descends back down to this ratio around between 15 and 16 to 1, 15.5 to 1, whatever, it's around there. This is 1873. When the dollar went off of silver in favor of a gold standard. Why did that happen? Because rich people own gold and poor people own silver, or poor middle class people own silver. And the rich people wanted to take money from the poor people, so they put the dollar on the gold standard, which increased demand for gold, decreased the demand for silver, destroyed the purchasing power of the poor people's money, and increased the purchasing power of the rich people's money. And then you needed paper money to divide the gold into smaller units, because you can't just go around shopping with gold coins, but a paper substitute for gold coins that could divide them artificially by paper receipts served well. Now, in 1919, you had a monetary panic because the world was going back on a gold standard after the money printing of World War I. Monetary panic, and what is happening? What is happening is that the paper substitute for gold was no longer trusted because of all the money printing from World War I. So instead of passing around the paper, which is generally more convenient than passing around the silver coins, the people said, we don't trust this paper anymore because of all the money printing that had happened, and we want the silver coins physically instead. So therefore, the price of physical silver around 1919 at the end of World War I descended to the monetary ratio of 15 to 1 because it was physical coins that were being demanded, and silver returned to being the direct money. Not to say that silver wasn't money here, but because the paper was generally trusted in this time as being well administered and not too manipulated, then people preferred the paper over the silver because that's normal to want paper over silver because silver is hard to carry and paper is easier to carry. But when the trust is lost in the paper substitute, then there is demand for the actual physical stuff. We saw that here again in 1968 when the London gold pool collapsed. There was a thought, there was a feeling that there was a monetary crisis going on, and there was, which is why Nixon took us off the gold standard around here. This is the collapse of the London gold pool. You see the fall back to the monetary ratio of 15-1. And in 1980, we all know what was happening. That was a dollar collapse, or the dollar on the verge of collapsing, on the verge of hyperinflation. And there was physical demand as a monetary store of value among the public for silver. What this chart shows you is the reason that silver descends to 15-1 in times of monetary panic is because it is a money. We are correct. It's not always expressed that way consciously, but when there is a loss of faith in the paper monetary substitute, and then the only choice the public has is to get into the physical supplies of silver and actually take the stuff physically off the markets and hoard it as a store of value, that is when the monetary ratio of gold to silver goes down to 15-1. That is what we are waiting for. The purpose of silver is that you can't go around transacting in gold because it's not practical. It's worth too much. You can't go to the supermarket with gold coins. You can go to the supermarket with silver coins, or you can go to the supermarket with paper or digital dollars if the paper or digital dollars are trusted as a silver substitute. But once the public does not trust these things anymore because they are being way too printed and way too manipulated, the public will go to silver as a money. They will return to that directly because silver is a money now. It's just not directly a money because there is still enough trust in the paper for the paper to serve as the silver substitute. But that is going to change, and the physical silver supplies are going to be hoarded and raided once trust is lost. That is what the Jeffs do not understand. They don't understand that the stackers are right, that we are just waiting for the next panic into physical supplies. It has happened 3 times since 1873, 1919, 1968, and 1980. It is going to happen again because human nature does not change. There is nothing new under the sun, and the dollar is not magic. It is still a silver substitute. This is what the Jeffs do not understand. This is why we are right. And we only have to be right once, because once this panic happens, the signal to sell our silver or to cash in our silver for real goods and services will be when the ratio falls back again to 15-1, because it's not going to descend much below that. It might maybe get to 10-1 for a day, but those who say it's going to go to 1-1 for gold and silver are crazy, and they're in this pie in the sky. I don't know what they're thinking. We have a clear signal for what to do. We wait for the panic, and when it goes to 15-1, that is when we disgorge our supplies and get rich in real terms. And yes, there is manipulation of the silver market simply because there is more notional silver traded than silver existing. When the dollar is silver and the ratio is honest and there is no inflation over the actual silver supply, then there is no need for silver futures markets at all. So the very existence of a silver futures market is itself the manipulation of the silver market. That's what it is. And the reason that the Jeffs and our side, the stackers, cannot talk to each other is that we disagree on what silver is. In the Jeffs' opinion, in the big bank's opinion, silver is simply an industrial commodity that crazy people who like shiny stuff enjoy hoarding because they're nuts. Whereas our side says that silver is a money. It was a money, it is a money, it will be a money directly again. It might not be a money directly now, but it will be again when there is a panic in the silver substitute supply, which there will be, as there always is. And you know what? When there is a panic, even the Jeffs will be among the hoarders. And when you buy low, you get mocked. It's a good thing. And when are we going to want to sell our silver? We're going to want to sell high when everybody wants it. And we will provide it. And they will be better off for it. And we will have the stuff. This is Ralphie of the Endgame Investor. If you enjoyed this video, then subscribe to a 2-week free trial of the Endgame Investor, where we are getting ready for the silver explosion and the gold explosion and the general commodity explosion and the implosion of the dollar. Or you can become my patron on Patreon, where you get a weekly biblical commentary themed video on monetary and economic topics, if that is indeed your thing. If it's not your thing, You can become my patron anyway and just not watch the videos. See you later.